Hey guys, what are bonds? No, I don't mean James Bond. I mean bonds, the investment tool, the investment vehicle that people use to invest their money in. In today's video, I'm going to be answering the question, what is a bond? And give you a few basic definitions and things you need to know moving forward if you ever decide to invest in bonds. Now, if you stick around for the entire video, you're going to probably learn something about bonds that you can take with you the rest of your life. So if that sounds good to you, do me a favor, smash the like button and let's jump right into it. You probably hear the word bond all the time, but a lot of people just don't know exactly what a bond is. So what is a bond? A bond is just a loan from you to a government or to a corporation for a certain period of time. And when that period of time is over, you get back your money plus any interest. So a bond is basically an IOU to you from the borrower. The government or the corporation is borrowing money from you and giving you an IOU in exchange for your money, right? So when you buy a bond, you're actually giving a government or a corporation capital in the form of money. You're handing over your money and they're handing you back a bond certificate or an IOU that says we're going to pay you back your money plus interest at a certain amount of time. So a bond is simply a loan from you to that government or to that corporation, and they give you back an IOU, which is a promise to pay you back in a certain time frame with interest. So think of a bond like this. A bond is simply an agreement that is a legal contract between a lender and a borrower. Now, you're the lender because you're handing over the capital or the money to receive the IOU from that government or that corporation that you're buying the bond from. So yes, a bond is a legal contract. Now, bonds are generally a safer investment because of the fact that it's a contract, unlike stocks, right? So with a bond, if the borrower doesn't pay you back, you can oftentimes seize assets and sell them off to get your money back if you have a bond. Again, a bond is a little bit safer, less risk than a stock. Now with a stock, the company that you own the stock in, they're not legally obligated to pay you anything back if something goes wrong with the company, or the company loses money, or the company goes out of business, or the company has 2 or 3 down quarters and doesn't make a profit. They're not obligated to pay you back anything when it comes to a stock. You as a stockholder, you don't have any legal recourse. But as a bondholder, you oftentimes do. And that's what makes stocks more risky than bonds. And that's why stocks offer a higher return on your investment than a bond does, because bonds, again, are much safer. So if you want your money to grow astronomically over lots of years with compound interest really making the money grow fast, you're probably going to want to invest in stocks. Bonds are going to get you much lower returns, and oftentimes people shun away from bonds because of that. Stocks, they make you a part owner. With a bond, you're just a lender who's looking to get your money back with interest at a certain period of time down the road. So just a few definitions that I want to tell you guys about in terms of bonds. There's something called face value, or what's called par value. And that's simply the amount of money that's promised to be paid back to you at a certain maturity date. Now, a maturity date is the date that the principal is to be paid back to you as an investor. And that maturity date, it represents when the government or that company, when their obligation to you is over and done. Now you have secured bonds and you have unsecured bonds. Now a secured bond, just like a secured loan, is a bond that's backed by collateral, just in case they can't pay you back. Now, an unsecured bond is simply a bond that's not secured by any collateral, just like an unsecured loan has no collateral backing it. So an unsecured bond is a bond where the principal and interest is only backed by the issuer of the bond. Now, that takes me to the definition of a yield. You might have heard the words bond yield at some point, right? So a bond yield is just a measure of the return you get back for an investment over a set period of time. And it's usually expressed in a percentage. So the higher the yield, the better the investment for you as the investor, but that higher yield always comes with higher risk. Keep that in mind. So a 15% yield is better for you as an investor than a 5% yield. But there's more risk associated with that 15% yield because it's likely a lower rated bond. And we'll talk about that in just a moment. Now, for example, there's the 10-year U.S. Treasury bond. And those bonds right now are around 3.9% compared to the Treasury yield in Russia For example, the Treasury yield in Russia right now is around 11%. Higher. And it's higher because what's happening in Russia right now? Well, they're in the middle of a war with Ukraine, right? So what's going to happen with their yield? It's going to be higher. It's going to be more risky for you if the bond yield of a country or corporation is 11% versus 3.9% or 4%. It's more risk to you as an investor that you may not get your money back at the maturity date. So over in Russia, there's more volatility happening right now in their economy and with their overall government than there is in America. The U.S. Treasury is just one type of government bond. So the question may be, well, why does a government or a corporation even need to issue a bond? Well, there's really one primary reason that a government or a corporation will issue bonds, and that is they need to pay for something. And so how do you pay for something? They have to raise money and raise capital in order to pay for something. Now, that something could be debt. It could be bridges. It could be roads. It could be hospitals. It could be schools. It could be something for the infrastructure of the city or the country. It could be a new warehouse that needs to be built for a corporation. Now, why do I keep saying government entities or corporations? Because there's really three primary types of bonds. There's government bonds, there's municipal bonds, what's often called munis, and then there's also corporate bonds. Now, what a government bond is basically when a government tries to raise capital to support or finance their debt, or to support or finance a large major spending or building project. And government bonds are backed by governments. And as we know, governments typically don't go out of business, right? So government bonds are typically very, very safe ways and safe places to put your money. So they're lower risk, and that means they have lower yields. Now, a municipal bond is the same concept, except it's for a city or a smaller municipality. Typically, a local government issues municipal bonds, or it could be one of the local government agencies as well. Not just the overall government, it could be an agency within that government that issues a municipal bond. And so again, municipal bonds are for local projects. Hospitals, airports, schools, local roads, and local infrastructure related repairs. Now, the other type of bond is a corporate bond. A corporate bond is a bond that's issued by a corporation to support and finance either a large build project or some type of debt. So large companies typically raise capital by selling bonds. Now think about that. Businesses go out of business all the time, right? So when you compare a corporate bond to a government bond, corporate bonds are more risky. They oftentimes offer you a higher yield, but they're more risky in general. And so one of the ways to offset that is corporate bonds typically have credit ratings associated with them. And that credit rating system rates a company's credit worthiness. So low risk bonds are from companies that have higher ratings. The higher the rating, the lower the risk, and the more possibility that you're going to get your money back when it's due. If you want to sort of ensure that you're going to get your money back, then you want to go with the higher rating bonds in terms of corporate bonds. But remember, the higher rated bonds are going to give you lower yields. Now, there's some credit rating agencies that you might have heard about out there. Moody's, Standard & Poor's, those are companies that rate credit worthiness of corporations. And so you want to be familiar with that if you ever want to invest in corporate bonds. Always check their ratings. They're really, really important in terms of making a good decision. Corporate bonds that are rated AAA, those are the highest rated. The ones that are rated C and below, those are lower rated bonds. And the lower you go, the closer you get to what's known as junk bonds. And you might have heard of junk bonds, right? Because every now and then, every 10, 15 years, junk bonds make the news somehow, right? Because of some type of shenanigans or something. But the lower the rating, you get closer to those junk bonds. Remember, the lower the rating, the possibility of higher yields, but of course, more risk for you, the investor. So there's a couple of ways you can buy bonds. You can buy a single bond by itself and hold it until maturity, right? Or you can invest in a bond index, which is basically a large group of bonds, maybe 100 bonds or 1,000 bonds that are all lumped together. And so what that does is it lowers some of your risk. Maybe within that 100 bonds, there might be some bonds with a low rating and some with a high rating, but it reduces some of the risk when you buy an index of bonds, a group of bonds together. So it's your choice. You can buy a single bond or a group. The group of bonds spreads your risk around. So to buy a corporate bond, you have to open some type of brokerage account. And you can open a brokerage account at a place like Fidelity or Vanguard or Charles Schwab or TD Ameritrade. You can open up a brokerage account and start buying corporate bonds there. Or you can buy them from a bond broker or a bank as well. Now, if you want to get a U.S. government bond, you want to go to the website Treasurydirect.gov. When you go to that website, they'll give you instructions on how to buy U.S. government bonds. And if you want to buy municipal bonds, you can typically go to your city's government website and they'll have instructions on how to actually buy a muni or a municipal bond. So just to go over some things that are good about bonds. Number one is a possible stream of income from the interest payments on maturity dates. Another pro for bonds is less risk, and that can offset some of the volatility that you find in the stock market, because the stock market is going to be up one day, it's going to be down one day, it's going to be kind of all over the place, very volatile. Well, bonds kind of even that thing out for you. So when things are way up and way down in the stock market, bonds are typically much more steady because they're less risk. And the other thing about bonds is when you fund a corporation or fund a government, sometimes that is a patriotic thing to some people. Some people like buying bonds simply because they're funding the U.S. government, or they're helping fund a city government, or they're helping fund a large corporation. Some people enjoy buying bonds just for that reason, the patriotic aspect of it. Now, some of the cons, some of the reasons people don't like bonds is simply this, guys. Bonds don't offer you a very high return. They just don't offer enough returns. And another reason people don't like bonds is because you don't benefit from the growth of a company or a government with a bond, like you do with a stock, right? When a stock goes up, you benefit. You get dividends, the price of your stock increases the amount that you have invested, but a bond doesn't do that. You get no extra incentive or benefit from the growth of that government or from the growth of that stock. And you don't have any ownership in that company when you have a bond with that corporation or a bond with that government, right? So there's a lot of reasons that make bonds unattractive for a lot of people. But I want you to keep this in mind, guys. Stocks go up, bonds go down. Stocks go down, bond yields typically go up. And that brings me to this topic, guys. Who are bonds good for? Why would somebody ever want to even invest in bonds? Now, some people, they say nobody, right? They don't like bonds, and so they say nobody should really be investing in bonds. But really, bonds can serve a good purpose for somebody that may be older and may not want to deal with the volatility of the stock market. They may just want to get their 2% or their 3% or their 1% from a bond, as opposed to the potential of a 10 and 12 and 15% that they can get from a stock, right? So maybe if you're a very conservative investor that doesn't want to take so much risk, right? So there's reasons that people actually want to invest in bonds. But the point is, do your own research. Bonds can get very, very complicated, right? I'm giving you a basic overview, sort of a 30,000 feet look down on bonds so you can get an idea what they are. But at some point, you may want some bonds in your portfolio as you begin to invest. So I gave you guys a lot of information in this quick video, but I want to go through a real quick recap, right? A bond is simply a loan from you to a government or to a corporation. Bonds are less risky than stocks are, and therefore you typically get a much lower return with bonds. And if you ever want to buy a bond, always check the bond's credit rating. And keep in mind, you can buy an individual bond or you can buy a bond index, which again lowers some of that risk for you because a bond index gives you hundreds of bonds, all in one package in one bond index. And always pay attention to a bond's yield. The higher the yield, the more risky. The lower the yield, the less risky for you as an investor. Guys, I hope this quick video helped you understand bonds just a little bit more than you did before you watched the video. You may want to keep this video saved so you can refer back to it when you get to the point where you're actually investing in stocks and you might want to look at some bonds. So feel free to come back to this video and check it out. Remember, personal finance is personal. And if you enjoyed this video, do me a favor, smash the like button below and check out a few of the videos in the description box below and some of the videos right here about growing your money and investing your money. Remember, the best person to take care of the old you is the young you. Do me a favor, guys. Take care of yourself and always take care of other people. Until the next video, peace.